So friends, now let us understand different plans of investment. First we will understand relax plan. Suppose you are having 1 crore rupee in your bank account. Here we have taken the example of 1 crore. Doesn't mean that minimum ticket size is 1 crore. You can do this kind of investment with small amount also. But here we have taken the example of rupees 1 crore to make it a rounding figure. So suppose you are having 1 crore rupee in your bank account, you want to invest money. So you will bifurcate your 1 crore in two checks. 30 lakhs you will park in equity segment and 70 lakhs you will park in debt segment. Why in equity segment? Because we want growth. And why in debt segment? Because we want safety. So in equity we will buy the index ETF of rupees 30 lakhs. So 30 lakhs rupees stocks of index ETF we will get in our demat account. And we will put that stock as collateral. That means we will put them as a margin. And we will take the position of index futures of rupees 70 lakhs from this margin. So indirectly we have made the portfolio of rupees 1 crore by buying 30 lakhs rupees stock as well as 70 lakh rupee futures of index. So we have the index portfolio of rupees 1 crore. Now if market will rise, we will earn on 1 crore, and when market will fall down, we will lose on 1 crore. But we don't want to lose on 1 crore, so immediately we will buy the protection. By buying this protection, by paying this premium of 5%, we have got the confidence that now my complete 1 crore portfolio is protected. In any case, if market will fall down, then my equity stock of 30 lakhs are protected as well as index futures of 70 lakhs are also protected. One more cost I need to pay, that is called financing cost. Why financing cost, my dear friends? Because we have made the portfolio of rupees 1 crore by investing 30 lakhs only. So 70 lakhs futures we have bought. When we buy the futures, every month we have to roll it over. And when we roll over the futures, we need to pay forwarding premium. So 30 points, 40 points a month comes to around 400 points a year. So indirectly 4 to 5% becomes the cost for us for futures financing. And this has become the fantastic opportunity for us to make money. Because indirectly we are getting the funds at just 5% a year rate. So if we are getting the funds at 5%, we should take it and we should put our own money in debt. RBI bonds are giving us 7.15% interest. So by paying 5% interest and by receiving 7% interest, we are generating 2% more returns. So on 70 lakhs 5% cost means around 3.5% cost on full portfolio. So just 3.5 lakh rupee. So indirectly for the portfolio of 1 crore, we have paid total cost of just 8.5 lakh only. So 8.5% cost has given us two extraordinary advantage. Advantage number 1, that my portfolio is protected. And advantage number 2, that on investment of 30 lakhs, I am going to earn on the portfolio of full 1 crore. Rest 70 lakh rupee we have parked in debt. Suppose it is generating the interest of 7.15% only. So indirectly 5 lakh rupee we are going to earn as interest income every year. So my net cost is just 3.5 lakh only. That indirectly means that if market will fall down, then my maximum risk is 3.5%. And if market will rise, I am going to earn on full portfolio. We have named this plan as relax plan because after understanding this plan we feel relaxed. The next plan is basic plan. The difference between relax plan and basic plan is that how we are using the rest 70 lakh rupee fund. The initial part of relax plan and basic plan is completely same. We have invested 30 lakh, we have made the portfolio of 1 crore by incurring the cost of 8.5%. Now rest 70 lakh rupee, instead of putting it at 7% on bonds, there are few customers who can say that I am having some better opportunity, there I can generate easily 9 to 10%. Then we will recommend them to use this fund over there. Or some of you may say that I am already carrying some loans and I am paying 10 to 11% interest over there. Then we will recommend them to repay their loan from the 70% of fund, because you have already made the fund portfolio of 100 by investing 30 only. So 70 are idle with you. So if you can generate little bit higher return from this 70 lakhs rupee fund, suppose you have generated 9% income, then indirectly you will have more interest income and less overall cost. So you can reduce this cost further by putting rest 70 lakh rupee fund more smartly. So the basic plan, theme of basic plan is to invest rest 70% fund somewhere else. The third plan and the last plan is power booster plan. Why we named this plan as power booster? Because here you can use the power of your current portfolio. Suppose here you have invested 30 lakhs rupees to buy index fund so that you can put them as collateral. But if you are already having the equity or mutual fund portfolio, then you can put your current equity or mutual fund portfolio as collateral and you can buy futures directly from the collateral of your equity or mutual fund. So without investing any money, you have bought the future of full 1 crore rupee. Again you have made the portfolio 1 crore. If market will go up, you will earn on 1 crore and you don't want to lose on 1 crore, so you will buy the protection by paying this 5% cost. Second cost is financing cost, and this time you are going to pay the financing cost on full 1 crore portfolio. Why? Because this time you have not invested 30 lakhs also. So on 1 crore 5%, that means 5 lakh rupee you are going to pay as financing cost. So instead of 8.5%, this time your cost has increased to 10%. But the fantastic point is that now your investment is 10% only. By investing 10% money, you have made the portfolio full 100% portfolio. So for 1 crore you have invested 10 lakhs. If you have made the portfolio of 10 lakhs, you would have invested 1 lakh rupee only. Rest 90% fund is idle. So if you can generate 9% income on 90% fund, indirectly 8.1% you are going to get back as interest income. So now your net cost is just 1.9%. So friends, by this way you can reduce your cost extensively and simultaneously you can generate extraordinary return. So in next 3 plans, you understood that relax plan, basic plan and power booster plan. All the plans are generating return on full portfolio. Second similarity is the downside you are having limited risk, and third similarity is upside you are generating returns on full exposure. So these were the 3 plans of index long term strategy. Thank you.